I just want to outline a little bit of the process this morning. We have the first item, which is a simple action item of approval of the agenda. We're going to take that in open session. We're going to hear one comment from the public. Someone has submitted a statement that they would like to read into the record, and in a moment we'll acknowledge that gentleman. We will then, after the one action item, which is the approval of the committee agenda, we will adjourn out of open session and then proceed into closed session for an item that we have listed for about 90 minutes. So if, in fact, that takes place, we would probably not reconvene into open session until about 11:30 this morning, approximately, if we use the full 90 minutes. And then, as you can see, we move into the consent agenda, and then we have three action items, including the semi-annual reports by our consultant, PCA, the real estate semi-annual performance report, and the private equity performance report, semi-annual. We have a couple of policy issues that we'll be dealing with, information items, and then closed session. So we have a full agenda in front of us today. So with that, what I'd like to do is entertain a motion to approve the action item number 1, the approval of the committee agenda.
So moved.
Okay, it's been moved and seconded to approve the committee agenda and work plan. All those in favor say aye.
Aye.
Opposed? Say no.
Mr. Keeley,
yes.
my apologies.
Correct.
Can we go ahead and take the roll?
Mr. King, would you call the roll
Just
for us,
too
please?
efficient for us.
Oh, thanks. Mr. King?
Sure. Yes, sure. Thank you. For the State Treasurer, Ms. Milleron. For the Director of Finance, Mr. Reyes. Present. Mr. Lawson. Present. Ms. Hendricks. Here. Ms. Dillon.
Here.
Mr. Rosensteel. Here. For the State Superintendent of Public Instruction, Mr. Zeiger. For the State Controller, Mr. McGuire. Chairperson Keeley, you do have a quorum.
Thank you, Mr. King. So now I will entertain a motion to approve the committee agenda and work plan.
So moved.
Okay, it's been moved and seconded to approve the work plan. All those in favor say aye.
Aye.
Opposed? No. Okay, thank you. That is passed. We're now going to hear from Bob Williams, a member of the public, on an item which is not before the board today. This is an item that staff has been made aware of. I've distributed a letter that Mr. Williams will be reading into the record. As chair of the committee, I'm also aware of this matter. Mr. Williams.
Thank you and good morning.
Good morning.
My name is Bob Williams. I'm the Assistant Business Manager for the IBEW Local 340 and a delegate to the Sacramento Sierra Building and Construction Trades. I'd first like to comment on this beautiful building, which I might add was built all union and was built on time and within budget as purported by the Sacramento Bee. I would like to read this correspondence into the minutes on behalf of Neil M. Struthers, the Chief Executive Officer of the Santa Clara San Benito County Building and Construction Trades Council. Dear Mr. Keeley and members of the Investment Board, we are writing to you because of your recognized commitment to principles of social justice. The Santa Clara San Benito County's Building and Construction Trades Council is deeply concerned that CalSTRS investment priorities have undermined the standard of wages and benefits that working families have struggled to establish and maintain. We would like the board to assure us that future investments meet criteria that reflect the high standards of social responsibility. San Diego developer Fairfield Residential, LLC, has entered into joint venture with CalSTRS to begin construction of the North Point project valued at $68 million in North San Jose at East Tasman and Zanker. At the end of 2007, CalSTRS infused this relationship with $350 million in equity on top of the $1.1 billion it has invested in projects developed by Fairfield since 2002. Fairfield has retained contractors on this project whose pay packages, in some cases, is less than 20% of the area's standards. Ironically, there are contractors working on this project who have provided no benefits whatsoever, abandoning their workers to the largesse of the taxpayers for health care and retirement. Some of these contractors have a long history of unfair labor practices and labor code violations. Plans are underway for the second phase on another parcel adjacent to this site. The application of strict standards of social responsibility is not foreign to large public investment funds. We ask you to reevaluate your long-term investment on this project in consideration of your geopolitical principles. Perhaps it may be time to review current policy to ensure that it adequately addresses serious issues of training, wages, benefits, and human rights. For example, recognition of the International Labor Organization core labor standards and the UN Global Compact would be in line with other funds supported by the pensions of hardworking union members. We are willing to meet and discuss these issues at any other time. Thank you.
Thank you, Mr. Williams. This item is not on the agenda, so it would, as I understand it, would not be appropriate for us to engage in conversations about this item. But what I'd like to do is direct staff to look into the issues that have been raised, to keep the chair apprised of what you find, and between now and the June meeting, and at the June meeting, provide the full committee with a update as to some of the issues that have been raised both in the letter and the comments, and any concerns that we should be aware of relative to risks to the overall system based upon the issues that have been identified. Okay? Okay. Thank you. Thank you, Mr. Williams, for your comments. Sure. With that, we will adjourn open session. So if you should not be in the room, you should exit, and we are scheduled for 90 minutes in closed session. So open session is adjourned. Been moved and properly second to approve the minutes of February 3rd, 2012 of the Investment Committee's open meeting. All those in favor say aye.
Aye.
Opposed? Thank you. Item number 6 is a consent, item number 5 is a consent agenda information item regarding the private equity credit enhancement. Are there any questions for staff on that item? Seeing none, I'll entertain a motion to approve item number 5 on the consent agenda.
Move approval.
It's been moved to approve item 5.
Oh.
Is there a second? Moved by Sharon Hendricks, seconded by Terry McGuire to approve the consent agenda item number 5, private equity credit enhancement. All those in favor say aye.
Aye.
Opposed say no. Item passes. Chris, are we ready? Is client advisory, have they been notified?
Yep, they're here.
Good, good,
right.
good. Thanks for that, Chris. All right, Chris, it's your item, item 3.
Okay, thank you. I want to go through a bit of a slide presentation and then hit on a couple of points that are within the report. Last month or last meeting, I told you that we were muddling along, and we laughed at this picture. But it's been interesting. I am hearing that constantly in the press as a common term of the idea of muddling along. I still can't find a better picture. But the staff pointed out to me that, and I said, I was looking at this year April report to last year's April report, and it was actually Michelle Cunningham who came to me and said, it doesn't feel like muddling along. It feels like Groundhog Day. You can remember that sequence of events. And there's a lot of similarity. So this is a slide of fiscal year 2010. So last year, June 30 to April 10th. Market was up about 29% after about August. Here's the same chart for the same exact time period this year. And notice, again, about a 29% return, this time off the September lows. So I'll go back again. There is last fiscal year over the same time period, June to April. And then here's the current chart, June to April. So it does feel a bit like deja vu or Groundhog Day, you know, waking up and it's the same day all over again. But there are a few differences this time. So one of the things we talk about all the time is Europe. Europe still does matter. These yields are slightly lower than they were back in February. And the graphic that just appeared, I wanted to share that with you. That is the seating chart of the European Parliament by party. But what I think it shows is not only, as I've said there, 27 countries, 23 languages in that room, but just the idea of how difficult it is to get things done in Europe and in Parliament. The length of time the committees spend in Brussels, and the fact that there are 3 different capitals within the European Union, but just even the composition of the different groups. The little gray sliver at the end are the ones that are the independents. So it just shows you everyone has a different stake and a different tact. And the colors within that represent the party. There are countries within all of the parties. So you can't divide it up and say the left or the right or the green or the peace and freedom. So this is our fiscal year to date from June 30. We do stand for the many of the teacher members in the back of the room write a newsletter after each meeting. The official number for today is we're at about $152 billion in assets. So we've come back from where we were in the wintertime. We're back over 150 billion, but it's been a slow climb. This is our fiscal year to date returns. Most of the numbers are as of Wednesday's close, so they don't include yesterday's rally. But what I thought I would point out is that what's different this time is last year when we looked at the returns, they were high 20% returns because the low occurred almost at June 30. This time, the low occurred way out at the end of August, almost September. So we've had a loss and then had to recover from that loss. So in this fiscal year, the return equity market's only up about 4.1. What's amazing is the impact of tobacco stocks. And you're going to see that when Alan shows you our peer group performance at December 31 and our peer group performance next August or September, he'll show you for June 30. People that invest in the full market will have a significantly higher return. Tobacco stocks, for whatever reason, have had a much larger influence, and so would account for almost 40 basis points. So our index is only up about 3.6%, or 3.7%. Non-U.S. is still negative. Fixed income is the best reporting asset class. A lot of people have been asking about this number, and including Ed Durman, because of all the conference calls from yesterday's agenda item. We finally, this morning, got this March 30 number. So as of March 30, 3/4 of the year, we're up 2.9%. So a far cry from 7 3/4, but a lot better than the negative return we were at back in December. We're crawling our way out. Obviously, we have 90 days left in the fiscal year, which is a long time in the financial markets. But we're working back to that. That's where we are right now with private equity and real estate on a 1/4 lag. They just got posted into the fund. I wanted to talk a little bit about the Apple effect. I mentioned tobacco stocks, but obviously Apple has been a very dominant stock, largest stock in the U.S. market. It is the largest stock in the Russell 3000 and in the S&P 500 index, so it's dominating the markets. And look at these results. There's a chart of what Apple's done just since June 30. So, you know, it definitely looks, I don't know, like a reverse ski slope or a ramp up. But there right now are about 2,930 stocks in the Russell 3000. I know it doesn't make sense, but trust me, X tobacco and X that. Apple makes up 65% of the return so far this fiscal year. So look at the very last column. I picked some different time periods. You know, the first quarter return for the U.S. index was 12.9. Apple by itself, the one stock, made up 1% of that. Since the rally really started in December, it's been that. But since June 30, Apple's responsible for 1.84%. The rest of all those other stocks only have gone up 1.1. So Apple is by far the dominant factor. I sent you out an email talking about some index funds, and unfortunately in index funds we own companies that do go down the drain, and we're going to ride them unfortunately all the way down into the ground. This is an example of the flip side. Our index funds own the proper market share exposure to Apple. Our active managers are chicken, and I don't blame them, at buying a stock at 500 and hoping it goes to 600. So our active managers typically don't own enough Apple. So in this case, we're glad we have the index fund and that it owns everything, so that we're in a stock like this that has outside performance. So you see the pluses and the minuses of an index fund owning everything, but sometimes like this, it works to our advantage, and we're glad we're exposed to the stock. As a side point, I have been talking to the staff about, given the sheer size of Apple, it is not the biggest stock exposure in the index in history. We've had other periods where IBM or other stocks became a big part of the index. But right now, Apple does rank in about I think the 6th largest exposure in history for the index. But we are looking at the issue about, should we buy puts or find some way to hedge that exposure potentially if the stock dropped a considerable amount, not a lot. And I'm not, since we're broadcasting on the internet, I am not predicting Apple stock to go down. Obviously, with Apple TV, the sky's the limit, right? Some people have said $1,000. But it means that we have over $1 billion, $1.5 billion exposed to Apple. That's significant. 1% of the fund, then we need to take that's a specific risk. Should we buy insurance to protect on that risk? So we are pricing that out and looking at that. Alan's going to touch on this a bit, so I won't go into great detail, but these are the PCA's risk factors. That is another thing that's different this time than we were a year ago. The interest rate risk is now definitely in the danger zone. Interest rate risk was high a year ago as well, but it's even higher now because rates have softened even more. And we'll get into duration, I think, a little bit in Alan's report, but duration risk in fixed income is actually very high. And it's an area that people just aren't thinking about risk in fixed income, but it's actually very, very strong right now. And Michelle and team are prepared to talk to you about it. This is our asset allocation. We're very tight to the targets, as we've told you before. Pretty much right on the mark in U.S. equities. We are low in fixed income, and that's part of that concern about that risk in fixed income. And I want to zero in here because what is important is private equity, real estate, and fixed income, and those don't line up exactly. I'm sorry about that. But the first one is real estate. We are near the top of the range. The second one is private equity, where we're definitely right near the top of the range. And that's part of the discussion we had earlier about why a certain amount of money is being invested or not invested. Mike and Margot are also aware, because I'm talking to them, about our exposure to those asset classes. And then the biggest underweight is in fixed income. But in each case, we're fairly tight. We have tighter ranges than other pension plans, which are typically plus or minus 5%. Ours are plus or minus 3%. But I wanted you to know those are the tilts that exist in the portfolio right now. This is one of the charts that is in your report that I sent you. And I wanted to note, I do use those boxes on the edge. I do color code them and try and put the shadow in a purposeful direction to give you kind of at a glance, what are the economic indicators telling us? Again, I'm using that same kind of coloring scheme that you see with, I keep saying Gardner, it's Grant Thornton, thank you. Green being good, yellow being caution, red being bad. And the economy really is pointing upward, as we've been saying, slow growth. We're starting to see second quarter earnings per share announcements. They're coming out. Alcoa came out 2 nights ago, and we're going to hear tons of them next week. That's really going to drive the market. There was already discussion. I made this slide last week, but there was discussion this morning about QE3. Are we going to get it? I called it 2.0, but maybe it's even 3.0. We're not sure, but we're going to have QE3 again and again and again. And really, it's going to come down to who's right, Bonds are assuming the economy is weak. Stocks have been showing that the economy is strong. Usually one of those markets is right and one's wrong. And the crowd behind me can all vote, and we talk about it. Here's a chart of how stocks are doing. I put those symbols just so you could immediately phrase it February to Easter. And one of the things, we do a lot of fundamental analysis, which is talking about the economy, that's chart before, but we also do technical analysis, which is looking at chart patterns, because that shows psychology. This shows you how the U.S. market has kind of hit some peaks, but not really run away in the last 60 days. And we are starting to go into sort of a soft patch. That top pattern would say that the market's a little range bound. And so we'll see. I can't tell you between now and June 30 that we're going to go back to those highs. We are a little bit worried about the downside, but we think it would still, the S&P would still say somewhere in the 1,300 range. So the market could trade off as it did last year in the second quarter of the calendar year. And that's one of the reasons we're concerned about it. The challenges that ahead, so again, last couple slides, if I go up into the crow's nest and look out on the horizon, these problems remain absolutely. China's GDP report that came out this morning is what caused our market to trade off. So Wall Street still is focused in on Europe and then the hard landing and soft landing in China. I think it was brought up an interesting point, and I have to admit it's not on my list to look at, which is the unrest in Syria and the Middle East. I will take a harder look at that, and I think we'll do a deeper dive of, is that more of a risk of contagion than we realize? I think we've all kind of felt that the Middle East has just been settled down. Syria is a big problem, but it's isolated. But clearly there's something else to watch there. In terms of other issues that are going to come up, the stuff that we always talk about, but I wanted to highlight one of them, and I first will say the disclaimer, I'm not a geologist. I'm not a earthquake authority. I don't even know what their specialty is called. But 2 points. I want to talk about earthquakes, and the other is we do talk about the Strait of Hormuz, but I did run the numbers so you're aware. That shipping lane is only about 6 miles wide. It's 2 miles, a 2-mile median, and then another 2-mile lane. But 35% of the seaborne shipped oil goes through that passage every day. So that's why that strait is so critical and so important from a global standpoint. Here's a chart I pulled up of the Ring of Fire. You're probably all very familiar with that concept of the Pacific platelet moving around. And it talks about all the subduction zones. What I thought was interesting is I threw on there the recent earthquakes, and there is a pattern of February of 10, then March of 11, and now April of 12. And it does bear pointing out that the Strait of Juan de Fuca up in the Seattle, Puget Sound area, and then our famous fault are the only part of that Ring of Fire that has not had a stress relief in a long, long time. And as I said, I'm not a geologist. I'm not sure how you can turn that plate and not have that one point breaking a bit. So I hope I'm very wrong, but that is a risk that will remain out there. And I think we'll try and do some more work on earthquake insurance on some of our properties, because we do have a lot in Seattle and we do have a lot in California. With that happy note, I'm open to questions.
Thank you. Thank you.
You want to talk about subduction zones? Yeah.
Thank you, Mr. Ellman. Any questions or comments from committee members? Seeing none, we will adjourn for lunch and a recess for lunch and return in 30 minutes.
So I'm looking at this.
Okay, we'll reconvene the investment committee with item number 6 on the agenda, which is an action item. General Consultant Alan Emkin from PCA, semi-annual performance report. Alan?
Mr. Chairman, members, Alan Emkin, PCA. Alan Emkin, PCA. Good afternoon. I'm going to target with your permission, Mr. Chairman, just a little bit of context today, because there are new members, and it's important to understand how they might choose to use the report, because
That would be helpful.
it's a tool, but it's a truly dated tool. And the reason it's dated is that the data is for year end, and your staff has reported interim numbers that are much more timely and up to date than are provided in this report. So the report is really a vehicle to open up discussion and dialogue that is more general and big picture as opposed to micro. And the goal today that I had set for myself was really just to focus on a single issue. And that issue is risk in the fixed income market. And in closed session, your staff, who's seen this in advance, will be prepared to specifically address how they're addressing that issue. But I want to focus on fixed income risk and some numbers, and then talk about some risks in the markets in general, a little bit about asset allocation, and then entertain your questions, if that's okay. On page 2 of our report, what we now do is a one-pager that tries to target topical issues that we believe are important for you as policymakers to consider. And an issue that is front and center in our mind today is fixed income risk and interest rate risk. And the reason that's important is that in your planning and in your thinking, both in your roles as fiduciaries here and in your personal lives, most people consider fixed income the safe part of their portfolio. And that is where you go to, number one, diversify, and number two is that the traditional term is that's your anchor to windward. Well, we would argue, and we would urge you to consider that today, possibly the riskiest part of your portfolio is fixed income. And I need to explain why. The fixed income, with a little bit of credit analysis exception, is a mathematical problem. You can look at fixed income, and there's very little forecasting involved in the long term. You buy a bond, you get a coupon. The only risk you have is reinvestment rate, and as long as it doesn't default, you know what your yield is on day one. Today, the real interest rate that's inflation adjusted of the 10-year Treasury bond is negative, which basically means if you held it to maturity, you were guaranteed to get a return that's less than inflation. Your benefits are going to grow in real terms. So a significant percentage of your portfolio is in an asset class, which will, as a matter of math, almost certainly not generate a real rate of return, even though the assets against it, the liabilities against which it's being invested for, is in fact going to grow in real terms. Why is that different today than it's been in my 25-year, 30-year career doing this? The difference is that for basically 25 years, all of my clients were relative return investors, which basically meant they just needed to beat a benchmark. And that benchmark was generally the S&P 500 or the Lehman, now the Barclays Aggregate Index or a real estate index. And as long as you outperform that index and then aggregating those in a percentage to a total portfolio benchmark for your total fund, you were considered to do well. So even if the portfolio was down, if you beat it, it was considered a successful year. Well, 2008 made the institutional market very humble. Because first and foremost, what you found out is that not all bonds are an anchor to windward. And in fact, high-yield bonds, lower-rated corporate bonds, private mortgages, those which don't have a federal wrapper around them, all went down at the same time as the equity market. So a big chunk of your anchor to windward, in fact, became dead weight as opposed to the exact opposite. And that's not true just for CalSTRS, it's true for almost the whole institutional investment community. There was little, if any, benefit in fixed income diversification if you weren't holding government bonds in 2008. So the clients began and are involved, as are you, at looking at two things. Number one, looking at, yes, how do we do relative to a benchmark, but more importantly, how do we do absolutely? How do we do relative to our 7.5% interest rate assumption? Because that is the only way, in real terms, in inflation-adjusted terms, that you can pay benefits. You cannot pay benefits with relative rates of return. And that's changed the focus of looking at an asset class, which was traditionally your anchor to windward, and recognizing it has the potential to be something very different. The fixed income market was also perceived to be a less volatile market. What we've seen in the last 90 days in volatility in the fixed income market is shocking. I got some numbers while I was listening to the earlier presentations. At the beginning of the year, the yield on a 10-year Treasury was right around 2%. Today, as we speak, I checked before I got up here, the yield on a 10-year Treasury is 1.98%. On March 19th, it was 2.39%. That's a move of 40 basis points, or a change in yield of almost 20% in 3 weeks. That's not supposed to happen in fixed income. That's not what fixed income traditionally does. And so, as you'll hear in closed session, your staff has taken a variety of actions because they saw these facts, and in fact, they've adjusted the portfolio in a way to do as well as you can do in that environment. But the challenge is truly, to you, is do you look at the total portfolio as a relative return investor where you care about universe comparisons and did we beat our benchmark? Or do you care more about absolute return? And that is a discussion that we're not going to answer today. But it's the topic that I'm going to urge you to address at every investment committee meeting, to challenge all of your consultants and your staff. Will this help us make our 7.5% absolute return objective over time? So, first, with your permission, Mr. Chairman, are there any questions on this fixed income issue?
No, it's, by your presentation, we'll be having a conversation later on in the day with staff. So
Great.
Go ahead.
Just go to page 3, please. There are 2 tables there. One, the top one is compares your performance versus your policy benchmark. The one below it versus the median fund. What you can see for the 1 year, you outperform both of those. For the 3 years, you significantly underperformed. For 5 years, you underperformed modestly. And 10 years, you're basically flat for both of them. The 3-year number is driven by real estate. And those issues have been addressed separately. But you should recognize, had you had not quite as bad experience in real estate as did occur, your performance both relative to your benchmark and relative to your peers would have been significantly better. But for 1 year, you did well. You had a return of 2.3%. That's great, but you have a performance objective to improve the funding, which has got to be better than 7.5% on average over very long periods of time. So even though you beat your benchmark and you beat your peers, you lost ground relative to funding the pension plan. And you lost ground at 5%, and that's 5% of plus or minus $150 billion. And that's, in fact, on average, simple math, what happened over that period of time. Calendar 11. So far in your fiscal year, you're positive, but you've only got less than 90 days. The markets are extremely volatile, and you are significantly below, again, that 7.5%. And so the challenge becomes, in today's world, how does your staff look at the investment markets and the capital markets to generate a rate of return in the long term, particularly in fixed income, that will generate an aggregate return of 7.5% when a big chunk of your portfolio has an expected real rate of return of 0? And if I had the answer to that, as much as I like coming to Sacramento on a regular basis, I would not be sharing that with you for my current fee arrangement. But I don't have an answer. And no one out there has an answer, and that's what people are struggling with. So I wanted us to bring that to your attention. Just quickly on the risks, if you would please go to page 5. This shows at year end what we call our investment risk metrics. And when it's green, by historical standards, it looks like it's a good opportunity. And when it's red or approaching red, it's something that deserves a lot of attention. And the one that I'm going to focus on is the bottom chart in the far right, which is interest rate risk. And interest rate risk is at its highest level in 30 years. And that's measured by a term called duration, which measures the price sensitivity of something to movements in interest rates. And it is as high as it has ever been in modern times. And so the 10-year Treasury bond right now has a duration of about 9 years. That means a 1% move in interest rates. So if the yield on the 10-year goes from 2 as it is today to 3, and it was almost half the way there 3 weeks ago, you'll lose 9% in market value on that 10-year bond. So that's not a low-risk investment. Now, I don't know, and I don't think anyone knows, when interest rates will rise. In fact, they could fall. If they fall, the least of our worries is what's happened to interest rates, because it means that no one wants to own equities. They would rather own safe Treasury bonds than hold almost anything else, even though they're getting a negative real rate of return. That doesn't portend well for the economy. In fact, what would portend well for the economy if interest rates rose a little and there was some inflation, because that would indicate there'd be economic growth going on and the expectation that there'd be economic growth. That's not in the capital markets. As we speak today, the equity market is selling off and the bond market is rallying. That's good if you're a holder of bonds, but it's not good because it's an indication that there's not an awful lot of confidence that the economic growth everyone was hoping for in the first quarter will be realized. So there's a lot of risk out there. To give you a better graphic of that, let's see here. Please go to page 13 of ours, that's INV 100. And the top chart on INV 100 shows since 1980 the forward-looking real or inflation-adjusted yield of the 10-year Treasury bond. So if we were smart in 1982, what we would have done We wouldn't have bought the 10-year. We would have bought the 30-year strips and forgotten about them. That would have been the single best investment decision that could have possibly been made. Because effectively, we have almost a 30-year period where real interest rates and nominal interest rates did nothing but go down. The reciprocal of that is that interest rate risk went up. And as you can see on the bottom chart, the duration of that 10-year Treasury bond is at the highest point it's been in 30 years. I'm bringing this to your attention because my job is to tell you what the risks are out there. And I want you to recognize and query your staff, how are we managing this risk? And funds like yourself all across the country are dealing with it in different ways. You have no choice. You have to have the money invested, and a big chunk of it's going to be invested in fixed income. How you manage within that bucket is very important. And should you care about how you do relative to a benchmark, or should you care about your ability to meet benefit obligations? It's an important conversation, and the purpose of today's conversation is to encourage you to start it. In terms of the equity market, I encourage you to go to page 11, INV 98. And there what we do is on the top chart, is we show the perception of risk in the equity market as measured by the VIX. And in fact, the equity market is not expected to be as volatile as it was in the past. In fact, it has a lower level of expected volatility. It's ticked up in recent days, but relative to the level of volatility of 2008 and 2009, it's become quiescent. Included in the report are similar reports from 2010 and 2008, so you can see the changes over time. And the reality is things do change over time. In fact, there's more interest rate risk than existed. But interest rate risk has been out there for a long time. Inflation has changed. Equity volatility has dropped dramatically. It's important to understand that these things are not static. If you go to page 21, INV 108, that table shows the performance of the total fund over various periods relative to the median fund and relative to the benchmark. Over the long term, you're slightly better than the benchmark. You're basically at the median. Over shorter terms, very short terms, you do well on both relative and absolute. But over the 3 and 5, you trail, and that's strictly attributable to one asset class. If you go to page 24, INV 111, similar data but broken down by asset class. And if you take a look at under private equity, the subcomponent for real estate versus its policy benchmark, that number tells the whole story. Your staff and your real estate consultant have been aggressively working their way out of that and have had dramatic improvement in that area. You'll hear from them at the appropriate time. The only thing on asset allocation is you're overweight on private equity and you're sort of light on public equity. And on that, I would basically argue it doesn't matter. They're both equity. And the only benefit you get is that private equity is not publicly priced, so you get a diversification benefit by having that overweight. And in fact, that's been the best source of return generation in the portfolio. And having that overweight in a well-structured private equity portfolio will probably reflect well on investment performance over the longer term. Been a long day so far. Happy to answer any questions, Mr. Chairman.
Thank you, Alan. Questions or comments from any of the board members? Alan, before you go, I would like to issue laid out for us, a critical issue for us to address relative to fixed income. And how would you recommend that we, is that going to be discussed later on?
That will be discussed in closed session.
In terms of strategy, et
Right.
cetera. Okay, thank you very much. Seeing no questions, to entertain a motion to accept the report. Okay, it's been moved by Mr. Reyes and seconded by Mr. Lawson to accept the report. All those in favor say aye. Aye. Opposed, say no. Thank you. Item number 7 on the agenda is the semi-annual performance report ending September 30th, 2011, real estate. Ms. McGee from Townsend.
Pretty sure I knew. Thought Mr. DeRay was coming up with me. Good
Welcome.
afternoon. I will direct you to the thank you, real estate report in your book, INB 192, and I will attempt to get to that page myself. At your request, we're trying to provide you with an executive summary that really gives you the 50,000 feet perspective on what your real estate portfolio has done. Mr. Emkin pointed out that his materials were dated and that they were year-end, and you have more information. These are actually as of September 30th, so they are even more dated, and your staff does have more up-to-date information that they provide to you on a regular basis. In the executive summary, the things that I really want to point out to you is that you are within the range, as was indicated in Chris Ailman's report earlier. You're within the real estate range. We are going to continue to move comfortably within that range, both up and down, as we see opportunities in the market or don't see opportunities in the market. And as Mr. DeRay indicated earlier, there are some opportunities in today's current market cycle to be liquidating some of your more, not really opportunistic, but your core assets that we don't see as continuing long-term holds, or other stabilized assets that have reached a stage where we are comfortable selling them for an optimal price. So we'll be moving, again, just keeping you aware of the fact that we expect to be both above and below the target range as we reposition the portfolio toward what the board had indicated they wanted to do with the program going forward. We do think that we're still in a wait-and-see type of real estate market. Your presenter earlier this morning probably gave you more information than you know where we are in the market globally. It is, if anything, a benign recovery. It's going to be very slow. We don't, at this point, anticipate that there will be anything that will cause the economic recovery to be as extremely beneficial to real estate. Real estate is about jobs and about people having demand for the facilities that you own. And without a strong economic recovery, you don't have a really strong real estate recovery. Having said that, we did not develop much in the last market cycle, and so there is an ability to have demand even at a slower pace increasing beyond what we have as far as capacity to take that demand in the market. But it will not be like what we saw in the earlier 2000s, where we had double-digit rental growth and occupancy absorption. It simply doesn't have any appearance to be that robust. And then all bets are off if there's some kind of an evolutionary change in some technology or something that creates that demand, because the demand that we got in the last market cycle certainly would not have been anticipated when we were sitting in the last recession before that. So that's really what moves real estate for you. As of September 30th, for your portfolio, I want to point out that your leverage is now in compliance. Yes. And that was not an easy feat. Your staff worked very diligently to make sure that they got down within the ranges that this board was comfortable with, and that they did so in a very prudent manner without compromising going forward returns. We remind the veterans on the board, as well as point out to the new members of the board, that that reduction in leverage is going to have an unintended or a not preferred side effect, in that when you rode the market down, you rode the market down on a leveraged basis against an unlevered index. You are now going to ride the market back up on a lower levered basis against a leveraged index. You made the decision to move to a leveraged index because it should moderate your risk that you take, and it's the more appropriate benchmark for you. We didn't try to time it. We didn't try to make it so it made us look good, and it's going to be painful for the first couple of years. But ultimately, this is the benchmark most reasonable to measure you against. And as we get into the report, I'll show you the contrast between those two indices. But when you look at the numbers that Mr. Emkin presented, and the negative 13% for your portfolio is a levered decline against an unlevered benchmark. So that's part of the disparity, and also a core benchmark against a not core or a highly diversified and predominantly opportunistic non-core real estate portfolio for CalSTRS. So not exactly apples to apples. And we're working on this report to be able to give you a better perspective on how much of this return is on a risk-adjusted basis where you really should be. Let's see. I think that's it on that page. The next page is really for history because this reflects the new change in the benchmark. It's INV 193. Just reminding you that the Odyssey is the new benchmark. NCREIF was your old benchmark. And we will, as we incorporate it, we will blend it going forward. We do that effective June 2012, but we're giving you both sets of numbers in this report so that you can see what your policy benchmark would look like and what the report would look like if you were comparing it to the newly adopted benchmark. From a total portfolio perspective within the real estate portion, you have your NAV declined. I'm going to put my glasses on, excuse me. As of September 30th, you were valued at $19 billion, and that was about 13% of the total plan compared to the $18 billion or 11.8 as of March. So you actually had improved in value, not a whole lot, but most of that has been attributable to new contributions that have been made, particularly in the core sector of your portfolio. It's also net of any liquidations that have occurred. On the right-hand side where we show the number of investment positions, this is a little glitch between us and Private Edge that calculates the returns for you. They label investment positions by capital calls. You don't really have 304 investment positions. You did not increase in that many from first quarter to third quarter, that many new investment positions. You had new capital calls to some of your joint venture partnerships, and we'll work on netting that out so you can get a better position of how much you really need to be looking at in your portfolio and how active it is. Again, this is the benchmark. This is to compare your performance to benchmark. I want to focus you on the longer-term 10-year and just make some not just because it looks better there, but also because it gives you some multiple cycles. In 10 years, there's been both the down cycle, which severely impacts your 3- and 5-year returns. You also have the upswing that you had in the market. And if you look at that 10-year column, the dark blue is CalSTRS at 4.4. The 8.1 is your new policy benchmark, which would be the Odyssey plus 100, and the MPI historically. So that's including the fact that you were against an unleveraged benchmark historically, but only 1 quarter of using a leveraged benchmark. If that makes sense? Is that clear? Okay. The gray column is just the Odyssey 100, which would be your going forward benchmark and the expectation given the policy for risk composition that we've established. And then the final benchmark is the NPI gross. And so you can see the longer term variance in there and how you are closest to that Odyssey plus 100.
You need to find NPI.
I'm sorry. Yeah, acronyms. NPI is the NCREIF Property Index. It is a composite of directly or wholly owned assets, not necessarily wholly owned, but it is property level information on an unlevered basis, gross of fees. It's all property types and all held in institutional portfolios. The Odyssey is the open-end diversified commingled equity, I think it is, core equity. It is a pool of 18 open-ended funds that manage about 80% of their assets in core stabilized assets, fully occupied, leased, stable assets, and about 20% in more value-added strategies where they might be taking some lease-up risk, renovation, or rehab. It also allows up to 40% leverage, which your portfolio also allows. So it is a more apples-to-apples comparison to your portfolio. It's also, even though we don't have passive indexing in real estate, it would be the passive alternative to the program you run because you could theoretically invest in those 18 funds and track that index if you weighted it the same way the index is weighted. This is just a graph to show the market cycle. These are the 1 year, at year ending September 30th for each of those years, your total market value. You can see the decline through 2008 and then back up as we've had a recovery, 2009, and then back up as we've had a recovery in the market. Again, that includes both your capital deployed as well as your liquidations in the portfolio. And we are working on a way to get to the numbers so that we can actually do a same store analysis that shows of what you had invested then, what's it worth now, and not an exclusive of the sales and the new acquisitions. Part of what we try to do in our report is to ensure the board that we are in compliance with all of the policies that you've established, not just looking at the returns and whether those comply, but all of the parameters that you've established to control the portfolio. This slide addresses the strategy mixture within your portfolio. The green bar is your target. The blue box is the range within which we can operate, and the blue columns are your actual exposure. A little bit of history. When we began the relationship with CalSTRS, you were about 50-something% core and 50 non-core. When we reevaluated your portfolio and reclassified assets by the actual risks and the current position of the assets, you went down to 28% core, and you are now up to 31% core. We obviously are trying to move the portfolio in the directions in which you see the bars. We are working on core acquisitions. However, so is everybody else. I just spent 3 days at a business conference in Southern California, and every institutional investor in the room was talking about wanting core, stable assets. We're going to be more core. We're going to increase our core exposure. We've worked with your staff to do that diligently, but we also have worked with your staff to ensure that you're not buying at the peak of the market in the core market just because you want to be at 50% core. So we want to make sure we do it wisely and prudently, but not immediately. Not necessarily immediately. Value add is about right where we would like it to be. Your opportunistic is well above its region. You have a couple of things going on in that portfolio. Your opportunistic investments tend to have more term life, so some of those are beginning to liquidate and will have a natural liquidation and reduction in your portfolio. You also have new investments that are being made in order to ensure that when we get returns going forward, we can shore up some of those opportunistic returns that are being generated from poor performing vehicles. No real concerns on leverage. We are in compliance with your leverage policies, as I said earlier. That was not an easy feat. From a diversification perspective, there are no issues here. We will look to increase industrial and retail where we can, but we are less concerned about matching the NCREIF or the Odyssey Index and more concerned about buying opportunistically where property types are not overvalued. For instance, right now, apartments are exceedingly popular and pricing has gotten very high in some areas. So you have access to that property type predominantly through renovation or even through development of apartments, which is a better risk-adjusted return. Mr. Cayley? No. Okay. I can go through the different portfolios in detail. What I would just highlight for you is that your core portfolio down at the bottom there, you see the total core portfolio generated for the 1 year of 14.7 against your Odyssey of 17.2. Good returns, but we would like to see them stronger, again, still recovering from some of the lower returning vintages. And in the value portfolio, your total return was 24.6 compared to its NFI, your NCREIF Odyssey benchmark of 18.2, so you did exceed that benchmark for the 1 year number. And your opportunistic portfolio is, again, the drag on the portfolio. It's the largest portion of your portfolio, and it is missing its benchmark by a considerable amount of return. And that's just more detail on that, so I will stop there and answer any questions you have.
Those are negative. Questions from committee members?
Okay.
Did you have? Some of these managers we could address in closed session if they're specific.
Happy to address anything in closed session, yes.
Thank you so much. Any questions or comments? Okay, thank you for the report. I'll entertain a motion to approve or accept the report.
So moved.
It's been moved to accept the report. Need a second?
Second.
And seconded, moved by Mr. Lawson, seconded by Ms. Hendricks. All those in favor say aye.
Aye.
Opposed, say no. Okay, thank you.